Dram Etf is the most underappreciated AI trade. Everyone is chasing the same names: NVIDIA, Micron, HYNIX. But what if there was a way to own the entire memory bottleneck instead of betting on just one company? Let's talk about Dram, because this isn't a normal ETF. And that's exactly why it has exploded. Since launching earlier this year, Dram has surged nearly 90%. And the reason is simple. Artificial intelligence has created something Wall Street didn't expect: a memory supercycle. AI servers require enormous amounts of high bandwidth memory. And right now, memory is becoming one of the biggest bottlenecks in the entire AI ecosystem. That's why companies like Micron and HYNIX have become some of the strongest stocks in the market. And Dram gives investors exposure to all of them. Its largest holdings include HYNIX, Micron, Samsung Electronics, SanDisk, Kioxia, Seagate. This isn't a broad technology ETF. This is a concentrated bet on the AI memory trade. And that concentration is exactly why the fund has been outperforming. The top holdings account for over 80% of the portfolio, which means when memory stocks run, Dram runs. But here's what makes this story interesting. Industry reports suggest memory shortages could continue all the way into 2027. Supply remains tight. AI demand keeps accelerating. And unlike previous cycles, memory manufacturers have shown far more discipline. That's important, because historically, memory stocks have been boom and bust businesses. Too much supply destroys pricing. Profits disappear. Stocks collapse. But this cycle may be different. AI is changing the equation. HBM memory demand continues to explode. Pricing remains strong. And some analysts believe we're only in the early innings of the memory supercycle. Now here's the catch. The ETF isn't cheap anymore. Dram recently traded near new highs. Technical indicators are flashing overbought conditions. Momentum is extremely strong. But strong momentum doesn't always mean immediate upside. It also means volatility. And this ETF is designed for volatility. Because the biggest risk isn't the companies. It's the cycle. If AI spending slows, if memory supply catches up faster than expected, or if hyperscalers reduce capital spending, the entire thesis could change very quickly. And because the fund is highly concentrated, drawdowns could be violent. This is not a set-it-and-forget-it ETF. It's a high-conviction AI infrastructure trade. And if the memory supercycle continues, Dram could remain one of the biggest beneficiaries. Because AI isn't just about GPUs. AI needs memory. And without memory, nothing else works. Sometimes the biggest winners aren't the companies everyone is talking about. Sometimes they're hiding in plain sight. And Dram might be one of them. Hit the like button, subscribe, and let me know in the comments. Do you think the memory supercycle is just getting started? Or has the market already priced in all the good news?